you're making investing way harder than it needs to. I want to look at investing kind of like a hobby. It's the idea that you can spend any amount of time on it, and the more you put into it, the more you're going to get out of it. When you go to a doctor and they tell you, like, oh, you need to exercise this amount per week, it's not, oh, you need to do, lift these amount of weights and do these sets. It's a general, just getting out there and doing it is the most important part. And that's the whole point of this channel, is that just investing is the goal. It doesn't need to be more than just throwing some money into the market. It is like any other hobby where you have weightlifters that are maximizing their macros, getting exactly the amount of protein that they need. And you have people that are day trading, are making specific stock trades every day to try to maximize their returns. But it doesn't have to be that way. And I feel like for most people, the best way to maximize the stock market is by keeping it simple. I got a message or a comment on one of my last videos saying, hey Andy, can you do a video about index funds versus individual stock? I love the idea of the diversity of the index gives. However, when it's up, it's great, but when it's down, it hits your portfolio pretty hard. Do you think it's better to have positions with individual companies within the index itself? So today I wanted to talk about two main topics because I think this is the area that people get kind of carried away when it comes to investing. You have so many different options, and you go on YouTube and you look up the best stocks to buy, and people are just going to bombard you with all of these stupid penny stocks that have only gotten notoriety in the past week because they're up 50%. That's not what I want to look at. I want to talk about keeping it simple because I think that's the best way to build wealth for normal people. So I wanted to talk about two main topics, and I'm going to have timestamps down below if you'd like to swap around or move between parts. The first one is going to be, when does it make sense to buy individual stocks versus the whole market? And then diversification. When does it matter and when does it not matter at all? Most of the investing world is focused on buying individual stocks. This is how the business of YouTube is pretty much set up. You have individual stocks that people are making very opinionated pieces about, trying to make their case or why you should buy it, because in theory, if you're buying the stock and more people are holding it, it's gonna go up. That's what all of these clicks are based off of. It's a clickbait of trying to find the next best, Tesla or Netflix, which was the top performing stock in the 2010s. And so you have all of these options, and there's so many ways that you can go about it in looking to find the perfect stock. It's not worth the time for 99% of people, in my opinion. Buying the whole market protects you from a lot of the downside risk of buying individual stocks. When you buy individual stocks, you have the potential of it doubling in a week, but you also have the potential of it going bankrupt. When you buy an index, you are diversifying and buying the whole market, meaning that when the whole market goes up, you're kind of buying the economy as a whole. When the market goes up, it's going to take you up with it, but when things go down, you're not going to be at risk of having these individual stories coming out about a company that's going to tank your portfolio as a whole. So you're never really going to have a down 20% day if you're buying just the overall market, but you definitely could have that if you're buying individual stocks that has a poor earnings report or a news story that comes out that really spooks the market. So when you're buying the overall market, you are really limiting the amount of variation that can happen in any given day. You're really narrowing the band, but you're limiting your upside risk. That's why people are so set on trying to find the best stocks, because you absolutely can find a stock that goes up 1,000% in a month, whereas the overall market is never going to do that. But I think it's more important to limit the downside risk than it is to maximize the upside risk. If we get 10% of your returns, we're going to do incredibly well. But the way that you really set yourself behind is by having a down 50% position. And if you're buying the overall market, it is much more unlikely that's going to happen, and we're trying to minimize that risk at all costs. So I wanted to talk about an individual stock to just kind of show how this can happen. Meta, or formerly Facebook, did incredibly well in the 2010s, and they've really switched to a different type of business model in the past couple years, and going into 2022 and in 2021, it had a really tough time. Then you have news stories about them laying off employees, go into an earnings report that looks pretty negative, but they announce a stock buyback and it goes up 20% in a single day. So over the course of the past year, it's down like 45%, even more than that. But then you have this incredible jump, and that's the type of variation that you're going to get with an individual stock as opposed to buying the overall market. The tech-heavy NASDAQ did incredibly well, but it would never dream of having a 20% day. That's just not going to happen because you would need the whole market to go up by that much, and that's not realistic. So I want to bring up my own portfolio because whenever I talk about stuff like this, I think it's really important to be transparent on what you're doing. When you come to my portfolio, I don't own fully market ETFs. When you look at it, it is 80% in individual stocks and 20% in market ETFs. The reason behind that is I'm very deliberate in the stocks that I own, and I'm trying to buy dividend stocks. Dividend stocks are one of the only times that I think it's worth maybe buying individual stocks because it gives you more variation in your income when it comes to dividends. I've made plenty of videos talking about dividend stocks, and I'll link them up above right now, or you can just look on my channel. They've probably been the last 10 or 15 videos that I've talked about. But it's the idea that these are stocks that have outperformed the overall market in the past 5, 10, 15 years but I'm buying them because they add a level of income that you're not going to get with buying a dividend ETF. It's going to pay you, quarterly. That's great. I want to have a little bit of mix where it's buying into the overall market at different times, and I think that's why it's attractive to buy these types of stocks. You look at my portfolio, I'll throw that up on the screen right now. You have some that are up. Apple, not a huge dividend stock, but it's up. AbbVie, one of my favorite stocks. Home Depot, pretty casual. And it just gives me a little bit more flexibility when it comes to dividend stocks, but I don't have any of these major high-flying tech stocks that are really going to get crushed in the past year. Yes, you can see PayPal at the very bottom. It's pretty small, but it's 0.4% of my portfolio, so I'm not worried about that. That was just kind of I have some extra money sitting around, I'll throw it into that. But the rest of it is sitting in QQQ and QYLD, which is a dividend-paying ETF. It's always covered calls on the NASDAQ, which is the QQQ. But when I talk about how I have my partner's portfolio set up, they only own 2 stocks, and I think that is the way to go for most people. They have 50% of their portfolio sitting in the NASDAQ and 50% sitting in the S&P 500. These are the ETFs QQQ and SPY. And when you look at them, this is when we start talking about diversification. You can see the perfect numbers where the perfect portfolio is between 8 and 12 stocks. You don't need that if you're buying market ETFs, and I'll tell you why. If you have 10 to 12 stocks, but they're all tech stocks, they're all pretty much going to go down in the same ways, especially if you've looked at the market in the past year. Tech stocks have gone down as interest rates have climbed because it is more expensive to borrow money, and a lot of these tech stocks are not profitable, and they're looking 3, 4, 5 years in the future to hopefully become profitable. But when the money becomes more expensive to borrow, that makes it harder to have that type of outlook. So you have a lot of stocks, and it could look like you're diversifying your portfolio, but if they're all in the same type of industry, you're not diversifying. So when you look at the NASDAQ 100, which is what I have 50% of my partner's money sitting in, you can see that it is weighted in different ways where the largest market cap companies have higher weightings. So you see stocks that I absolutely love, Apple, Microsoft, Amazon, Nvidia, Google, that type of stuff. It allows it so you get exposure to the tech stocks, which have done incredibly well in the past 20 years, which is why I think it's one of the better places to put my partner's money, which is why I own QQQ and why I have their portfolio owning QQQ as well. But it makes it so that you get the benefits of individual stocks going up, but if you have, let's see, Meta is the 8th largest on this portfolio. It's been dragging it down, but it's not going to pull the portfolio down 20% in a single day, and that's where the diversification comes into play there. Then the S&P 500, yeah, you have 500 stocks that you get the weighting from. You still have some of the ones we talked about before, weighting-wise, because the tech stocks have gone pretty much vertical in the past 20 years. You still have Apple, Microsoft, Amazon, but then you go down, you see Berkshire Hathaway, ExxonMobil, Johnson & Johnson, JP Morgan. You get the diversification of buying into a bunch of different markets, so I'm not worried about the tech stocks dragging it down the whole way. You have Tesla, which you have electric cars. You have ExxonMobil when it comes to gas and energy. You have all types of platforms and stocks that you're buying into, and allows you to protect yourself. So I want to go back to that original question that inspired this video, is when does it make sense to buy an individual ETF or an individual stock versus buying the overall market? The only time that I buy ETFs is if I don't really want to focus on picking individual stocks. The ETF that I have in my retirement account is TAN because the solar industry is something that I'm incredibly excited about. The problem is it's very complicated, and for most people, they don't want to spend time looking and trying to pick out what the winners and losers are going to be. If that's the case, I think buying an ETF that follows the entire market makes a lot of sense because the winners are going to pull you up, but instead of trying to buy a winner and avoiding the loser, the winners are going to pull you up and the losers are just going to pull you down a little bit. So it gives you some risk mitigation in that way. So that's one of the times that I would buy an ETF. But just for people that don't want to spend a lot of time researching in the stock market, I think it makes a lot of sense to buy market ETFs because you don't have to pick winners and losers. You pick the market and it goes up when the market goes up and it goes down, and you don't have to worry about a stock going bankrupt, because if the S&P 500 goes bankrupt and all the stocks go to zero, I think we're going to have a lot more problems on our hands than just our retirement money. We're going to have some more problems besides that. So I think for most people, it makes sense to just buy a market ETF, and the most important thing is not buying individual stocks and trying to pick the best performing stock. It's just making sure that you are buying into the market consistently and doing it for a long period of time. If you're throwing money in when the market's down and when it goes back up to break even and you stop investing, that's not what we're trying to do. We're trying to consistently add so that over time we can take advantage of those 10% returns. And even if you're not getting the best returns based off of where it was a couple months ago, it's all about the consistency and building that behavior so that you don't even think about it and it automatically does stuff. That's why I have DRIP, which is a dividend reinvestment plan, and have these weekly contributions that go in automatically, the less we have to think about investing in the stock market. I think that's the better way to go. For like 95, maybe even 99% of people, you have the people that want to buy individual stocks because they're trying to outperform the market. But I think for most people, we're just trying to get time in the market and not trying to necessarily beat it. In summary, most people will benefit from buying a market ETF just because it allows them to mitigate risk while also take advantage of the stock market going up. But there are some people, if you're trying to outperform the market, you're going to have to buy individual stocks, but you have to take on that additional risk. And I think that's something that most people maybe can look at. You can buy individual stocks if you really feel passionate about specific companies. But for when I don't feel confident about picking stocks, I buy market ETFs, and I think that's a great way to invest in the stock market for the long term. When you talk about the 10% returns that we've seen on average, we're talking about the S&P 500 as a whole, and not individual stocks, so that's the benefit of that. My name is Andy. I'm trying to keep investing simple, and I think dividend stocks and just buying the market ETFs are the way to go. Let me know what you thought about this topic, and if you'd like me to make a video talking about one of your questions that you leave in the comment section down below, be sure to let me know down below. I'll have some additional videos popping up on the screen right now if you want to see more videos from me, and I will see you in the next video. Thank you for watching.